let's get to our market panel. Joining us now is Tom Lee and MUFG Head of Macro Strategy, George Goncalves. Guys, happy Friday. Good to see you. Tom, the Russell 2000 was lower today, and in tech, even stability seemed to be in favor. Microsoft was higher, Meta doing nicely, IBM, Oracle. What does this week sort of ex-Bitcoin, we'll get to that eventually, what's the meaning of it for what you expect in January?
Well, we're 2 weeks into the year, and this week certainly feels defensive. I think investors are still debating whether or not this is going to be a market where the Fed is supportive. I mean, we had some comments where, you know, we've got some inflation reports, some confusion, and some uncertainty about whether the Fed is going to be sort of supportive market making cuts. I think January is kind of a microcosm of what the year is going to be like. I think it's going to be a very challenging year for investors, but you know, and our call has been that you make most of the money in the second half. So I think this is what January is reminding us of, that, you know, we're going to be a little anxious about the Fed in the first half.
And George, what's fixed income doing right now? I mean, valuations, as you point out in your notes, are kind of tied to that quite a bit.
Absolutely. I mean, the bond market's not confused. It's made up its mind that the Fed's going to cut rates. We had the two-year note basically move almost a quarter of a point, 25 basis points nearly this week, and the curve is starting to disinvert. So we're having short-term rates moving faster than long-term rates. Even some long-term rates are going higher slightly. But by and large, this has been a week where the curve is re-steepened. Rates are lower. They've been low all throughout this whole period. And yet, you know, we had some mixed news on inflation. But by and large, I think the bond market's made up its mind that the Fed's going to cut pretty aggressively.
And Tom, when you look at this week's data, particularly inflation data, CPI, you don't read it as being hot the way some others do. And maybe the PPI data that we got today supports that, right?
Yes, that's right, John. You know, core CPI, which was reported yesterday, came in at 0.3, and I think a lot of folks kind of zeroed in on the super core number coming in at 0.4. And what we pointed out was auto insurance is over half of that rise. So if you took out auto insurance out of core and super core, you'd be close to 0.2, which is, you know, basically at Fed's target. Auto insurance rates are rising because of loss severities over the last 2 years. It has nothing to do with the Fed keeping interest rates here, and it won't benefit from the Fed keeping rates here. It's really because car prices surged and auto insurers have to make their money back. So I think it's almost a statistical residual inflation number, but it's not really predictive.
But George, what would it take for the Fed to actually message that way? It seems like they just got off of the position of trying to convince people that they still might raise rates, so they're still hesitant to indicate any readable inclination to cut.
Look, they pivoted pretty quickly in December. We have a March cut as the first cut. We've had it since July of last year. Our view has been that, you know, the U.S. cannot afford high rates, and they're very restrictive. Let's be honest, 5.5% is very high in the U.S. They got to take rates down into the threes, and they have to start soon. So it's going to be the setup. Is it going to be a macro force, or is it going to be a combination of a macro force along with some sort of financial turbulence? If it's purely macro, the data has to really decelerate even further than what we got this week. And it could happen that way. In February, I mean, January data comes out in February and so forth. This Q1 data can be very weak, give the Fed the excuse to start the cutting process, and then watch and see how the economy reacts to it. So we're of the view that it come by February, there's a lot of revisions in the data, that it might actually revise down a lot concerning the birth death model on the NFP data. Inflation comes in lower. They have all the information there that they'll need to cut in March.
Okay. Now let's talk about Bitcoin. Tom Lee, we got the approval of the spot Bitcoin ETFs this week. Big up day on the first day, down today. I think, you know, for the week, about even. Is this ETF party that's now begun going to significantly change the way Bitcoin trades from here?
I mean, it is only 2 days in, John. So to me, I think it's going to make a huge difference, because instead of having to go to an exchange and then worry about your private keys, many investors can now use traditional financial markets to access Bitcoin there's $150 trillion of household net worth just in the U.S. I mean, allocating just 1% into crypto would be $1.5 trillion of inflows. I mean, that's already more than Bitcoin's network value. So I think there's tremendous potential, and I think it's a really important diversification for a lot of folks that have exposure to U.S. dollar assets, equities, or bonds. And, Bitcoin is really a good hedge against a lot of monetary risks.